Started by talking about gold's reclassification as a tier one. We talked about the central banks going on a buying spree. We talked about the central banks going on a repatriation spree. We've seen the rise of the classification called the others on the COMEX that had started draining the COMEX in 2020. This has never happened before. What the heck's going on? We've seen this trend continue. We see the central banks continuing to buy gold and silver. We see, and those numbers increasing. We see the repatriation by central banks continuing. We see the United States become a net importer of gold and silver, in particular gold, since November. We see massive deliveries into the COMEX since November. We see a LBMA breaking down. We see an LBMA that was T+1, now T+8 weeks. So from 1 day plus the trade day, 3-day settlement, you're now at 8 weeks. That seems like a default. We see JP Morgan, who always I lamented, how could they be allowed to be the custodian of the world's largest silver trust after paying the largest fine the Justice Department ever handed out for manipulating the market? Well, they've now become primary custodian along with BlackRock, not only of SLD, but also GLD. In two vaults, they hold more gold than 80% of the G20 countries. All of these things together are substantial. You put them together, something much bigger is happening. You look at Judy Shelton talk about 50-year treasuries that she is convinced will be announced on July 4th, 2026, the 250th year anniversary of this country. She says Trump has told her that. They've had discussions on it. You see talks from the head of the Dutch National Bank and the Bundesbank and Senator Loomis from Wyoming talking about revaluing gold. All of these things continue to come together. And maybe what's even the most interesting about all of it is that gold's at all-time highs, but how many people even know it? Yeah, the people watching this show know it, but no one knows it. I mean, it's so underplayed by the media. It's absolutely crazy. And if you would have told me we'd be at 3,300 gold and no one would notice it, I would be completely dumbfounded. And that's where we are. The retail hasn't taken part in this at all. So as we've talked about on your show a million times, the little man rule, or just the very fact that the big money always positions in front of the herd, well, you could argue that's what we see right now. And everyone's been waiting for the other shoe to drop in gold. You know, it did drop while I was in Europe, of course, and fell by $200. But when it fell by $200, the amount of closing out of open interest was in the billions of dollars. In other words, the managed money who had gotten really long against large short positions by the commercial banks, you know, how many more times can they do this? Can they drop the price down to bail them out? Well, that's what they did. They smashed the price and they closed like $4 or $5 billion, maybe even more $1 billion worth of contracts that were open, that could have stood for delivery. And then the price goes up $300. And the same thing is true with silver. So there are desperate attempts to keep the price from rising too fast and being on the wrong side of it. And yet, even after they smash it, where in years past it never would have come back, here we are way past where it started when they knocked it down to almost 3,000, just under 3,000, I think, from around 32 and change to now over 3,300. And it's come back in a matter of 2 weeks. And so there's strength and something going on in the gold market. And you put all of these things together, you have the biggest money in the world accumulating and onshoring and repatriating gold, getting out of the system. You have talk of gold being integrated into a new system. Even the BRICS has said, Dilma Rousseff, we've agreed to a new settlement token, the unit backed by and redeemable in gold. All of these things, how many clues do we all need to understand that gold is going to be somehow, some way, whether it be through the unit, whether it be through gold-backed treasuries or something that we don't see? Gold is reintegrating into the monetary system. And the biggest players in the world, I don't care what they say, their actions are telling you that is indeed the truth. No, you know, typically gold goes first, silver goes further. I mean, that's a truism that there are many examples where you can show that, but gold has gone first for sure. The setup for silver is even stronger and more compressed, like a coiled spring, than than with gold. And it's the reality that people don't want to deal with, that silver is more important than gold to some of the very big players like the military industrial complex, as we've talked about, who needs copious amounts to make their high-tech weaponry. And that works real well in an environment where no one's buying silver. But the amount of, look, we saw 50 million ounces delivered into the first day of the March contract, 50 million ounces on day one. And so the demand for silver is off the charts. You're seeing India buy 900 million ounces of it in the last 4 years or thereabouts. That's more than the COMEX and the LBMA combined. And you see China, the second largest producer in the world, flying all around Latin America, buying doré and concentrate. What do they need to do that for? And then sending it back to be refined. It's being accumulated by the state in Russia, the first government that I know of that's made a public admission. The amount of silver drained from the LBMA, 70 million ounces, all-time monthly record in January, huge deliveries in February, and very large deliveries in March, although the LBMA is kind of putting the brakes on it because they're getting bled dry. Evidently, it's a shortage of trucks in the UK that is not enabling them to continue to deliver at the same fashion. But any way you look at it, this is an opportunity that you don't see very often in investing ever, where if you traded your gold to silver, a double plus would be just reaching the 200-year average, price average of the two, which would still be over 6 to 7 times higher than it's coming out of the ground at. It's one of these deals where, I think the asymmetrical risk reward in trading gold to silver is probably the lowest I've ever seen, where you trade an ounce of gold, which, in fact, I did it gold eagles to silver eagles today, and it amounted to 85, 86 ounces in eagles. If you were to do it in something else, it would be even more. But even 86 to 1 in real terms is off the charts. So, you get 86 ounces of eagles for every gold eagle or thereabouts. And if all that we saw was that it went back to its 200-year price average of the mid 40s, you double what you started with by trading back into gold. And I think it's a no-brainer. So yeah, these are trades you don't see but maybe once or twice a lifetime or a career. It is a no-brainer from a standpoint of historical context in both gold and silver pricing and in their relationship. The basis trade is what we've seen happen just last week with the stock market and the bond market moving in opposite directions. And it was, in essence, the bond market coming this close to breaking. It's the exact same thing that happened with long-term capital management, the hedge fund, I think in the late 90s, that the Fed had to bail out because it was this close to breaking the entire system. And in essence, what it is that, and especially, and by the way, long-term capital management was a grouping of Nobel and like prize-winning economists. And I think a couple of them, or one of them, had won the Nobel Prize in economics. These were the smartest of the smart. They figured it was a risk-free trade. In essence, what they do is they buy as many 10-year treasuries as they can, and they lever up on it by going massively levered with using derivatives to buy as many 10-year treasuries as they can, and then simultaneously they short the 10-year treasury future, which has a little bit of a premium to it, and they just capture the spread because when it expires, they net each other out, and you just keep the premium. And that's supposedly a risk-free trade, and because of the Dodd-Frank Act and these banks can't do speculative things anymore. Well, so that's what they do. They buy all of these treasuries, and the Fed likes that because we've seen central banks selling. So get the hedge funds to load up on treasuries to massively use the collateral, if you will, to use the fractional reserve system type of environment of levering up those treasuries as much as 100-fold. Even at 20-fold, a 5% drop wipes out the whole thing. But at 100-fold, a 1% drop wipes out the whole thing. So you have these banks who think it's risk-free. They buy treasuries and sell treasury futures to simultaneously capture the spread. Well, what happened was last week when the 10-year treasury went up by 60 basis points at the same time the S&P dropped by 8%. they're supposed to move inverse of each other. If the S&P is throwing up, the money should be running into treasuries, into the safety of treasuries, which would lower rates. But in essence, what happened is the rates started to spike for whatever reason, which it blew out the short-term lending rate. So those short futures got margin called, and because it went up so fast, it went up 60 basis points in 3 days. It's the biggest jump in bond yields in 3 days since 1982, and it's probably the sharpest split between bond yields and stock prices ever. And so what happened was all of this selling, these hedge funds got margin calls and had to sell their treasuries, which pushed rates up even higher. And this is exactly what happened to long-term capital management. And so you're talking something that was hopefully contained, but it goes to show the amount of leverage that's in the system. And very easily, at the exact same time, we have $6 trillion in treasuries coming due next month. $6 trillion. We have 28 trillion due by 2028 with only roughly 15 trillion in tax revenue. That's a problem. How do you come up? You're 50% there and doesn't even take into account the spending we're doing between now and then.